You know that crazy bank run you saw all over the news? Well, that wasn't the start of the story for Silicon Valley Bank. Not even close. That was the final, chaotic scene of a much longer drama. A story about a corporate strategy that was, frankly, doomed from the start. Panic or no panic. Okay, let's get into it.
Because to really get what happened here, we've got to ask a much bigger question. See, this wasn't just about some bad bond investments. SVB was in the middle of this high-stakes identity crisis. It was trying to transform itself from a pretty standard regional bank into something, well, something much, much riskier.
So our story really kicks off back in 2020, like so many strange stories from that time. The pandemic created this really bizarre problem for banks, and for SVB in particular, they were absolutely drowning in cash, just mountains of it with nowhere to put it.
I mean, just think about it for a second. You had government stimulus money pouring into people's accounts. The tech sector was on fire with VC money flying everywhere. And where does all that cash go? Straight into bank deposits. But here's the twist. Companies and people were so flush with cash, nobody was really asking for new loans.
And this chart right here really shows you the scale of the problem. Look at that spike in deposit growth in 2021. Just unbelievable, all fueled by that pandemic boom. And then look at loan growth. It barely budged. For a bank whose entire business model is turning deposits into loans, this giant gap is a full-blown crisis. What on earth do you do with all that money?
Now, the whole banking sector was dealing with this. And to find a home for all that cash, they ended up buying about $2 trillion in new securities. So, and this is a really crucial point, SVB wasn't special for having this problem, but its solution, man, that's where things got uniquely dangerous.
So how did SVB tackle this? Well, their solution wasn't just one single decision, no. It was this two-part, super high-risk strategic gamble that was designed to both solve their cash problem and, really, to completely change the bank's DNA.
First, you had the now infamous bet on bonds, where they just loaded up the truck with long-term securities. And second, and this right here is the real core of their doomed strategy, they tried to pivot. They wanted to go from being a, boring commercial bank to a high-flying Wall Street player, chasing those exciting but super volatile investment gains.
Now, that whole bond bet hinged on this little accounting rule for held-to-maturity securities. By labeling bonds this way, they could basically pretend the massive paper losses from rising interest rates didn't exist. It made their balance sheet look safe, even while the real market value of their assets was absolutely cratering. It was a ticking time bomb, plain and simple.
But honestly, that bond bet was kind of just a sideshow. It was cover for the bigger, more ambitious gamble. This is what the execs were really excited about. Transforming SVB by chasing a totally different kind of profit, something called non-interest income. Okay, so your traditional bank lives and dies by net interest income. It's predictable, it's stable, it's also not very sexy. SVB, though, they wanted the exciting stuff, non-interest income. We're talking about the world of investment banking, fees from M&A deals, big gains from selling securities, returns on equity warrants they got from their startup clients. It promises these huge returns, but man, is it volatile.
And this chart just lays bare how fragile that whole strategy was. A big chunk of their Wall Street income came from gains on securities they could trade. And you can see it right here. It skyrockets in 2021 when interest rates were basically zero. But then, the second rates start to climb in 2022, poof, that income stream completely vanishes.
And it is the exact same story with another key income source, gains on those equity warrants from their tech clients. You see a massive boom during the zero-rate party and then a total crash when the Fed, takes away the punch bowl. So their so-called diversification into Wall Street, it wasn't diversification at all. It was just a different flavor of the very same bet that interest rates would stay at zero forever.
This quote from one of the analyses we looked at just hits the nail on the head. As their Wall Street dream fizzled out, SVB was just becoming what it used to be, a low-growth, low-margin business. The big transformation had failed. It was just a regular bank again, except now it was a regular bank with a completely broken balance sheet.
So you have to ask, why would any bank make such risky and frankly correlated bets? To get that, you have to look inside the company culture and, probably more importantly, at how the executives were getting paid. The incentives were just completely and totally broken.
Because as soon as interest rates went up, SVB got caught in this perfect storm that it created for itself. The bond portfolio, their first big bet, was losing billions in value. And at the exact same time, their non-interest income from that Wall Street gambit, their second big bet, just evaporated.
Both pillars of their grand strategy crumbled under the exact same pressure. There was no resilience, no plan B.
And if you want to understand the motivation behind all this, just follow the money. Look at these numbers. Over the last decade, SVB's CEO made $111 million. The CEO of First Republic, another bank that failed, made an eye-watering $356 million. Now get this, that's more than the leaders of Bank of America and Citigroup, banks that are exponentially larger. Paychecks like that incentivize one thing: short-term growth, whatever the cost. So, of course, the postmortems found exactly what you'd expect. Executive bonuses weren't tied to managing risk. In fact, their compensation rules explicitly allowed them to ignore investment losses when calculating their pay. And the cherry on top? The board of directors, the very people supposed to be overseeing all this, didn't have enough senior banking experience. There was no adult in the room to hit the brakes.
So when you put it all together, the bad bets, the broken incentives, the lack of real oversight, the conclusion is just unavoidable. This strategy wasn't just unlucky, it was structurally doomed, right from the very beginning.
And here is the absolute key takeaway. This is why it's so much bigger than just a bad bond trade. Even if SVB had been right, even if rates had gone back to zero and their bond portfolio was suddenly worth a fortune, it wouldn't have saved them. That would have just been a one-time gain. It wouldn't have fixed the fundamental disease, which was a business model that simply couldn't compete in a normal world.
When you boil it all down, this is so much more than a banking story. It's a perfect case study in corporate hubris. It's about what happens when a company bets its entire future on a single, temporary economic moment, that weird era of zero interest rates, and then just refuses to adapt when that world disappears.
Which really leaves us with one final and kind of sobering thought. SVB's entire grand strategy was built for a world that was already gone. So the question we should all be asking ourselves now is, what other companies out there are still building their future on a world that just doesn't exist anymore?